Assumption, what is it? How do you get it? Well, one thing is for sure, most people don't have a clue exactly what it entails. So we're gonna run through it for a few minutes exactly what an assumption is and can do for you. Hey, my name is Justin Henry. I'm the broker and owner of Justin Henry Real Estate Advisors. We help buyers and sellers all along the North Texas market. Been here for over 15 years. We love to help all our clients find the best deals on the market today. So please do drop us a line, go ahead and click the subscribe or tap the bell for more notifications. So let's get right into it. The mortgage loan assumption allows you to buy a home by actually assuming or taking over that person's mortgage instead of actually having to get a new mortgage. This has advantages for home buyers and of course the sellers too. Home buyers can get a mortgage with a lower interest rate usually than are certainly on the market today. Home sellers may be able to actually charge more for that home and also be able to offer that buyer a great reduced mortgage interest rate. How does the loan assumption process work? Well, you get approved just like any other similar loan. You actually need to complete an application, provide documents, meet all the lender's credit, income, and financial requirements to actually get the loan assumption completed. Lenders often have stricter mortgage underwrite standards for loan assumptions than they do for new loans. This means it can take longer to get an assumption approved compared to certainly a standard mortgage application. So can take longer in terms of a standard loan and versus an assumption. You take into consideration the interest rates, the number of years on the loan, the mortgage insurance requirements, and other terms of that current mortgage, because you do receive those. Loan assumptions usually include a release of liability. This means when the person actually assumes that mortgage, they're releasing it from the other party, and then they are then considered responsible for that mortgage if in fact they decide to default. You do need to make a down payment on these loan assumptions. So yes, that down payment can be quite large. That down payment, assuming you apply for a new mortgage, certainly would be less, but when it comes to, let's just say a house that has a large amount of equity, you're gonna be in a situation where, it's gonna be more. Let's just say we take a $350,000 home, the principal balance is $250,000 on the mortgage. That means that you're going to have to come up with $100,000 in down payment to buy the home. In some cases, some homeowners and some home buyers can actually finance a portion of that through a home equity loan. Let's just say, for example, you put $50,000 down and then put $50,000 on a home equity line. Do you have to pay closing costs on a loan assumption? The answer is certainly yes. You do have to pay loan closing costs. Further, you'll have to pay closing costs in cash too, because you can't roll in that cost into the mortgage balance. That's because you can't change the terms of that actual loan, right? The principal balance must stay $250,000. So, what kind of mortgage loans are in fact assumable? There's VA, FHA, and USDA are typically assumable. Conventional loans can sometimes be assumable in certain circumstances, and when you have a conventional loan, you need to ask your lender if in fact it can be assumed. It is possible for homeowners that are not veterans and active duty personnel to actually assume a VA loan. Assuming a buyer uses your VA loan to apply for a new VA loan, however, you need to ask your lender if you can then assume it if that previous VA veteran wants to use a new loan. So how do assumptions work when it comes to divorce or death? The process for loan assumptions as a result of a divorce or separation is similar to the process for when it is if it was a separate individual buying a house. The person that's in the couple wanting to assume the loan would have to fill out an application, meet certain lender credit, income, and financial requirements to be approved, and of course the other person is then released from liability to pay back that loan. When you inherit a house with a mortgage, the process for assuming the loan can be simpler, certainly. You'll need to establish you have the actual right to own the home, and that person's is typically called the successor in interest, and you work with the lender to assume that mortgage. Keep in mind that you're not required to assume the mortgage of a house you inherit. You can actually choose to sell the home and use the proceeds to pay off the mortgage. You can also certainly choose to finance by applying for a new mortgage instead. If you have any other questions about assumptions, certainly reach out to me. And once again, don't forget to like and subscribe.